Thank you very much. Thank you for the kind introduction. First thing first, a warm welcome and a big thank you to everyone who is attending this webinar today. I understand that this is obviously a Friday evening, and I appreciate everybody taking time to attend this webinar. So I'll try to make this webinar as fruitful and as interesting as possible for everyone. Let's jump right into the presentation. So the title of my presentation today would be China 2021, the road to recovery is still intact. As what was mentioned earlier, I'm Tan Jee Toon. I'm the Chief Investment Officer of Asia Pacific Equities at RHB Asset Management. So to start off, let us talk a bit about, I think, what are the key reasons why we are positive on China in 2021. So let us talk about the 4 key reasons before we will give an introduction in terms of our RHB Big Cap China Fund, followed by our portfolio strategy for this year. And I think the first reason why we think that we should be positive on China, essentially, it's related to the fact that China has great control in terms of the COVID situation compared to the rest of the world. So on this chart here, what I like to show everyone is the vaccination rates of all the different countries in the world. And I think everyone is well aware that countries, especially in the developed markets like US, UK, Israel, and Europe in general, have pretty high vaccination rates. However, if you compare that to the emerging markets, I think the vaccination rates for emerging markets is much, much lower. So when we did this chart, I think the world average vaccination rate was roughly about 12%. And if you look at the vaccination rates of the more developed regions in the world, North America roughly is about 40%. I think Europe is roughly about 35% as well. And if you could compare that with China, you will notice that China actually stack up quite well. So since then, since we did this report, I think China has continuously vaccinate its entire population. So roughly we are in the region of 40% right now. So that means that China's vaccination rate, in fact, is on par with some of the best vaccination rates in the world. And I think we all know that vaccination rates is important, because if we were to have any chance of some form of normalcy in the post-COVID-19 world, I think we need to have some form of herd immunity, and that can only be brought about by high vaccination rates, right? So this is something I just want to point out to everyone, which is to compare the vaccination rates across countries all over the world. And on that measure, I think China stack up very, very well, even against the more developed regions in the world. And on this chart here, I just want to highlight one key thing, which is to show what is the confidence level of the Chinese public in terms of their views and their opinions in terms of their own livelihood and in terms of their own economy. So on this chart here, I would like to show everyone the volumes of Chinese property sale over the course of 2021, which is the red line shown here. So on this red line, you can see quite clearly that the red line here, which shows the, like I said, the volume of Chinese property sales, that is indeed higher than the historical averages that we have come across over the last 5 years or so. So from 2016 to 2020, which is this blue, which is this dotted green line here, you can see quite clearly that the volumes of property sales in China is indeed much, much higher than the last 5 years average, right? So this is something I just want to point out. And I think that shows the confidence that the Chinese people have in their own economy and also in their livelihood. I think that shows that in terms of their confidence level in the government's efforts to control the whole COVID-19 situation. I think that is in stark contrast to the COVID situation that we see in other parts of the world. Okay, and on this chart here, I just want to highlight to everyone. So we all know that if you look at the developed markets in the world, their vaccination rates are indeed very high, right? So this is a chart that we did that was done in middle of June. This is a share of people, or percentage of people in the whole population who have received at least one dose of a COVID-19 vaccine. So what is interesting that we see on this chart is that you can see that for a lot of these developed countries like Israel, UK, US, you can see that the rates are actually tapering off, right? So once it hits roughly about 60%, the rates will start to taper off because at the end of the day, there will be a significant percentage of people in all these countries who are unwilling to take the vaccine, right? So why is that important and why we are monitoring this? It's because if the percentage of people that who did not take the vaccine is as high as 30% or 40%, then the hopes of the whole community having some form of herd immunity is actually quite low, right? So this is something I just want to highlight. So at this point in time, it's quite clear the developed market are well ahead of all the emerging markets out there in terms of their vaccination rates. But what I want to point out to everyone is I think we need to continue to monitor this vaccination rate, because as we get into the second half of this year, let's see whether this vaccination rate will taper off or not. Okay, this is something I just want to highlight. And why do I highlight that? Is because if you compare that with the vaccination hesitancy level in places like China and Asia, in fact, I think people in China and Asia are more quiet or more obedient, right? They are more willing to trust the government or in terms of willingness to take the vaccine. So my bet is as time goes by, right, our vaccination rates in China as well as in Asia would in fact catch up over time and in fact may be higher than what we see for the developed market. So I think this is a phenomenon that we are watching with keen interest, but obviously at these levels, definitely the emerging markets are way behind the vaccination rates that we are seeing in the developed parts of the world. But this is something that I just want to point out to everyone here. Next, the other thing that I think we should be very watchful for and we should be very positive on is the macro strength of China. So this is our second main reason why we think that we should be positive on China. So on this chart here, this is just a simple chart of the Purchasing Manager Index, which is what we call the PMI. So in general, the Purchasing Manager Index, it's used by investors like ourselves to give us a rough indication on how the economy is going to be, right? So roughly speaking, how do you actually read this chart? Okay, so like when we were in school, right? Everything that is 50 means that if you score more than 50 means that we have passed, right? Anything that's below 50 means that you have failed. So this is how we would interpret the PMI as well. So the higher the level above 50, the better it is, right? It actually shows that if you're above 50 means that your economy is actually expanding. So if the level is below 50, then which means that the economy is actually contracting. Okay, so we can see on this chart here for China, there's only one very, very short and sharp blip, and that happened in February of last year. That was when the whole China was in a lockdown, right? So during that period, obviously China was in a lockdown, economy was in a massive lockdown, and therefore you see that PMI actually reached only about 40. But as time goes by, in the next subsequent few months, right, you can see that China is expanding quite nicely. And in fact, if you look at the expansion of the Chinese economy, post that very, very short and sharp lockdown, you can see that it's essentially a V-shaped recovery. And since then, the Chinese PMI has been in an expansionary mode, which means that the PMI is actually above 50, right? So I think even to this year, PMI continues to grow, and it shows that the economy is expanding quite nicely. Next, on this chart here, I just want to point out to everyone the expectations of GDP growth across all the different countries. Right, so on this chart here, I have all the different key countries that I think will be of interest to our attendees today. And right at the top would be China. You can see that China expected GDP growth for 2021 will be roughly about 8.4%. And by the way, for the sake of consistency and for the sake of comparing apples to apples, what I did was I actually used IMF data. So this is not our internal data, but I use IMF data because I want a consistent framework whereby we can compare all the different countries' GDP growth on the same measure, using the same measure, right? So we can see quite clearly here, China's expected GDP growth in 2021 will be very, very strong, 8.4%. And that is in fact higher than all the countries that we have out there, except for maybe for India. India's growth this year is going to be about 12.5%. But having said that, I just want to point out to everyone, if you look at India's GDP growth last year, it's actually a contraction of negative 10%. So that is just a rebound from a sharp contraction that we see for India. But if you compare China, China is actually only one of the rare countries out there in the world last year that actually managed to grow. It grew roughly about 1.8%. But this year, despite the fact that it grew last year, it's going to grow very, very strongly again in 2021, right? So as you compare that, if you compare the the GDP growth of China versus other countries out there, be it the likes of the Asian countries or even the more developed markets like US, Europe, United Kingdom, you will notice that China GDP growth is indeed very, very strong, right, for 2021. And in fact, this growth will continue on in 2022 as well. And on this chart here, and another example of the macro strength of the Chinese economy. So on this chart here, what I have here is the data in terms of the China exports, right? So I have dragged the data all the way to pre-COVID levels, and you will notice that during the pre-COVID levels, which is essentially the part of the chart that is on the left of this V-shaped downturn. That was obviously during the lockdown of last year. So prior to that, you can see quite clearly that on a monthly basis, China export is roughly about 200 plus billion thereabouts. But after the COVID period, you can see that China exports have in fact been higher than the levels that we saw prior to the whole COVID situation. So roughly the China exports to the world is in the region of more than 250 billion. So roughly about a 20+% increase compared to the levels that we saw prior to the whole COVID situation. So I think that shows the resilience, the strength, and also how important Chinese exports are to the rest of the world. Okay, and on this next chart here, another example of the strength and the resilience of the Chinese economy. What I have here is a chart on non-performing loan as a percentage of the entire Chinese banking system. So we can see quite clearly on this chart here that during the US-China trade war, you can see that the non-performing loan, which was hovering roughly very steady, about 1.75%, during the US-China trade war, you can see that number ticked up to about 1.85%. But during the whole COVID crisis, you can see that number went up another level as well. From 1.85, it went up to 1.95%. But what is interesting from my point of view is this, right? From the third quarter or fourth quarter of last year, you can see that the NPLs, or the non-performing ratio in the Chinese banking system, have come down quite significantly. From 1.95, it's right now hovering about 1.8, 1.7%, right? So this is in fact lower than the levels that we saw pre-COVID situation. So I think that shows the better economic conditions that is in China right now. So I think all this, I hope everyone can see that indeed China's macroeconomy, or the economy in general, is indeed performing quite well. And on this chart here, I just want to dispel some of the concerns and try to allay some of the concerns that our investors may have when you read that, oh, China may be tightening or China may be slowing down, right? So on this chart here, I just want to put forth a data which we call the China Total Social Financing. Okay, titled China's Total Social Financing, or TSF, is essentially the total credit that is in the entire China banking system. So that includes not just loans, for example. It also includes things like debt. It also includes the shadow financing, right? All the financing, all the financial deals that is going underneath the radar, right? So if you look at this, right, you can notice that during the whole COVID situation, from roughly about 11% total social financing growth rate that we saw pre-COVID, it actually ticked up all the way to about 13 plus 14%. Why is that an increase? Because if you are the Chinese central bank, during that whole situation when the whole world is in a lockdown, you can only depend on yourself. So obviously, it makes sense for a lot of this, for the central bankers in China to actually stimulate their economy by releasing liquidity into the system. So as a result, we are seeing a total social financing growth, or the total credit in the whole China system, rise from the 11% that we saw pre-COVID to roughly about 13+% that we saw during the worst of times. Okay, but what is interesting, I want to point out to everyone, is the growth rate is indeed coming off. But I think what we should be thinking about in terms of this piece of data is more of a normalization. I don't think China is shrinking or they are decelerating, but it is more of a normalization. So just imagine if you are a central banker in China right now, okay, you know that you have released quite a fair bit of liquidity into the system to help the country during the worst of times during the whole COVID crisis. But right now, the whole world is slowly coming back on its feet. We have developed markets coming back online, ending their lockdowns, and even for the emerging markets, the vaccination rates continue to grow on a day-by-day basis. So things are indeed recovering. So if you are a central banker sitting in China, I think it's only prudent that you normalize some of the strong growth that was implemented during the depths of the whole COVID crisis. So as a result, from the 13+% that we saw in terms of total credit growth, it has come off roughly to about 12%. The other point I want to highlight to everyone is this, right? It is still higher than the pre-COVID growth rates in terms of the total credit growth in the system. So from my perspective, right, I don't think China is tightening, neither is it contracting, but rather I would see it more as a normalization. And I think this is the message that the central bank in China is trying to convey to everyone, to all investors out there. And more significantly, right, just very recently, over the course of last week, we saw that China actually cut the required reserve ratio for its banks. And more significantly, right, this cut is the first time that we have seen since the worst of times during the whole COVID crisis, since April of last year, right? For the big banks, the last time RRR was cut, that was during the whole COVID crisis when it was necessary to support the Chinese economy. But right now, at this point in time, right, I guess in part in terms of trying to send a signal to investors out there, I think these RRR cut does signal that there is support from the Chinese government in terms of supporting and trying to stimulate the Chinese economy, right? So this is something I just want to highlight to everyone as well. For those people out there who may have the impression that China is contracting or China is decelerating, okay? And moving on, I think the number 3 reasons why I think that it's time to be positive on China is that I think for the Chinese internet sector, we are seeing what I would call a new beginning, okay? So why do I say that? So I think everybody here will probably be well familiar with the Alibaba as well as the Ant Group IPO story. So maybe a bit of recap. Ant Group was supposed to be supposed to be an IPO at the end of last year in November. However, literally right at the last minute, the IPO was pulled, right? So that was cancelled, right? So some people speculate that it was something that maybe Jack Ma had said, or it was something that maybe Ant Group did something wrong, right? And as a result of all these concerns, I think Alibaba share price, which is the parent company of Ant Group, actually went on a tailspin. So roughly it corrected anywhere between 30 to 40% from that last high that we saw late last year, right? So that was the start of the concern that investors had on the Chinese internet sector. But what is interesting from my perspective is these few pieces of news, right? On the 12th of April, I think it was announced that Alibaba accepted a record China fine of $2.8 billion, right? And they vowed to change, right? So 2.8 billion obviously is a huge number, but however, I think we need to put that into the context or in terms of the balance sheet and the size of Alibaba, which is obviously an internet giant. So $2.8 billion, to put into context, is just roughly about 4% of Alibaba's annual revenue, 12% of Alibaba's annual operating earnings, or just roughly about 6% of its existing cash. So if you think about it, right, despite the fact that obviously $2.8 billion, don't get me wrong, is obviously a huge sum of money, but relative to the size of Alibaba, I think this is just a small little slap on the wrist for the likes of Alibaba. But nevertheless, right, I think there is a bit of conclusion, right? There was a fine and Alibaba was punished and they said that they will change. And the other thing I want to point out to everyone is, similarly, there was a big piece of news for Ant Group. We knew that the Ant Group IPO was pulled and then they were supposed to be revamped. And we received news of what actually happened. What is actually going to happen to Ant Group. It's not going to be closed down, or rather it was going to be revamped into a financial holding company, which I think makes a lot of sense. Because end of the day, right, Ant Group being a big financial player now, albeit online, I think they need to be supervised. And it being classified under a financial holding company makes a lot of sense, which means that, for example, the financial regulators are now able to regulate and supervise the entire Ant Group. So I think once again, right, there is some form of conclusion, right? So for people like ourselves who investors, what we need is we need the end of uncertainty. We need some form of conclusion. Once there's a conclusion, once there's a framework, then investors like ourselves can go in and objectively value all the different parts of the business. right? So these are the two key news that actually happened in April of this year, 12th of April and 13th of April. But also more significantly, I think on the 13th of April, it was announced that 34 key Chinese internet companies were ordered to do comprehensive self-inspection. So essentially, what the regulator asked these 34 key internet companies, which includes all the internet giants like Pinduoduo, JD, Kuaishou, Bilibili, Didi, they were all asked to do comprehensive self-inspection within 1 month, which means, right, they were asked to go back and sort themselves out if there's any mistakes or past mistakes, or there were things that they were not doing properly. They need to correct it within the 1 month period. I think this is significant because it shows on a few key things. One, it's not just Alibaba who's impacted. It's in fact the entire industry who is asked to do a comprehensive self-inspection, right? Because obviously quite a few of them, if not all of them, have not been following maybe the regulations right to the letter, right? So obviously then they had to do a bit of self-correction. So what is important from my perspective is, once again, right, we are looking at some form of conclusion, right? So we are looking at a big fine on Alibaba. We're looking at a revamp of Ant, and also these 34 key internet companies were asked to do a comprehensive self-inspection. So all in all, what I think is from that perspective is we are seeing some form of conclusion to the intense internet the scrutiny that was applied on all these Chinese internet companies over the course of the last few months, right? So this is something I just want to highlight. So some people may look at it and say, oh, these are all negative news. But from my perspective, right, I think this is the start of the ending of this scrutiny. Okay, and on this point here, I just want to highlight for these Chinese internet companies, once again, right, I like what this chart implied. I think they were at the wrong place at the wrong time. So during the March and April period of this year, there was this hedge fund in the US called Archegos, which is actually a family office of one of the more famous hedge fund manager. So what happened was he actually made the wrong bets on some of the US stocks. So as a result, right, a lot of his other holdings, which are, even though they're profitable, were affected as a result of this margin calls, right? And all this happened within a few weeks. And this was a big event for those of us in the investment world, because obviously the quantum was huge. I think it was rumored, but the size of this hedge fund was actually in roughly in the region of anywhere between 20 to $30 billion, right? So that was a huge hedge fund that they were talking about. And also more importantly, right, all their holdings were liquidated within days or even weeks, right? So that created obviously a huge impact on some of the stocks that were implicated, right? So, and why did they had to liquidate in such a short period of time? It was because a lot of international investment banks were involved, right? For example, the likes of Credit Suisse, Nomura, and Goldman, for example, they were all involved. So as a result, they had to lighten up their position fairly quickly, and so they were forced to sell a lot of the holdings of Archegos, right? So unfortunately, some of the holdings were actually of the Chinese internet stocks. So during that period of time, right, for our fund, our RHB BCap China fund, we actually took the opportunity to pick up a lot of these stocks during that period of time, because our view is this short-term correction, or in fact quite violent corrections, were as a result of non-fundamental factors, and it is actually good for us to buy during these times of market dislocation, when fundamentally there's nothing wrong with this company. So I also like to highlight this news article, rather than me saying that I think I was right to buy all this stock during that period of time. It's not just us who were out there buying. There were other big hedge funds or fund management companies out there who probably had the same thinking like ourselves. Like, for example, in this newspaper article, it actually reported that Soros Fund Management themselves were also buying the specific stocks that were affected during the Archegos collapse. So in the words of their CIO, she said that when there's a dislocation, they are prepared to not just double down, but triple down when the facts and circumstances support that, right? So I think this is a whole series of unfortunate events that actually took the market down, in particular the Chinese internet stock down in the first half of this year. So like I said, I think that we are probably coming to the end of that internet scrutiny, and also this one-off event in terms of the Archegos collapse. I think this is once again water under the bridge. Okay. And also on this chart here, I just want to highlight on a few things in terms of the valuations of this Chinese internet company. You can see on this chart here, what I have is I've taken the valuation trends of some of the key US and Chinese internet companies. So for the US, we looked at the likes of the Netflix and Amazon versus the likes of the key internet giants like Tencent, NetEase, and Alibaba. As you can see, right, from this chart here, previously, a few years ago, they were all trading more or less in line with each other. But over the course of this year, especially, you can see that the US internet stocks have in fact rallied very, very nicely. But the Chinese internet stock have more or less meandered or more or less have plateaued, right? So if you look at history, its own history, let's say for Tencent, I don't think Tencent is trading very, very expensive relative to its own history. Same thing for the likes of NetEase and Alibaba, right? And if you compare the Chinese internet names versus the US internet names, you will notice that the Chinese internet names are in fact trading at much cheaper valuation compared to the US names. So I think there is a huge valuation gap that creates opportunities for investors like ourselves. Okay, so the other thing I want to highlight to everyone is on TT. So I'm sure TT has captured the imaginations and of investors all over the world, right? It's obviously a very, very big IPO that just happened recently. It was one of the largest IPO since Alibaba came to the market. But what is significant is also, I think the government went in and actually tried to contain TT, right? The other thing I just want to highlight to everyone is our view is that I think this whole TT issue is probably more targeted towards TT more than anything else. So I don't think they are trying to target the entire Chinese internet sector. Okay, why do I say that? Okay, so we know that the Chinese regulator actually asked TT to stop accepting new subscribers. So, and they actually pulled their app from all the app stores out there. So they are not allowed to, if you don't have the TT app in your handphone right now, you are not allowed to download any of these apps from roughly on the 2nd of July, right? But what is interesting is Meituan, right? Meituan, who actually pulled out from this ride-hailing business about 2 years ago, all of a sudden, over the course of the last 2 weeks or so, suddenly emerged, right? They restarted the ride-hailing business, right? So if you think about it, right, our view is they are not trying to target the entire internet sector. So Meituan was allowed to revive its operation, despite the fact that it was closed 2 years ago. And Meituan Dache, which is the ride-hailing app, is now available, right? Whereas for TT, it's no longer available for download. Okay, so I think there is a big difference in the way that they are treating all the different internet companies. Perhaps one of the key reason is key things that we might want to look at is the shareholding structure of TT. So if you look at the largest shareholders of TT, so who exactly are these people? It's actually SoftBank, who owns roughly about 20% of TT, and Uber, who owns roughly about 12% of TT, right? So it's something that I think is probably on the minds of Chinese regulators when they look at TT. And also more importantly, I just want to highlight is I think the message is sent out pretty much loud and clear that I think the Chinese government do want the Chinese tech companies to be listed on either the onshore stock exchanges or on the Hong Kong stock exchanges, rather than be listed on the US stock exchange. And I think that actually creates opportunity for a lot of these Chinese companies who are able to take advantage of that. So from our portfolio, we have also shifted our positioning post the news of that happening to take advantage of the fact that we think that a lot of these Chinese tech company will find its way back on the Hong Kong Stock Exchange or on the Chinese exchanges. So these are some of the key things that we have done over the course of the last few quarters. And the fourth reason that I just want to highlight to everyone, I think which will be interesting, which I think is interesting, is that I think we have seen recent positive developments on the US-China tensions. So I think everyone is well aware of the tensions, the trade war, the tech war that happened during the Trump administration. I think what is interesting from our perspective is that during this Biden administration, on the 12th of May, I think Xiaomi was taken off the trade blacklist. And we think that's significant, right? So for those of you who are unaware, I think Xiaomi is obviously a Chinese handphone maker, very famous Chinese handphone maker. They also make consumer products, for example, the likes of vacuum cleaners, for example, the likes of TVs, and consumer products in general, right? So in fact, when Xiaomi was put on the trade blacklist during the Trump administration, we were actually very puzzled, right? Because if you look at the other names that were on the trade blacklist, they were more in the high-tech space, or they were more in the military space, or they were more in the sensitive technology space. But Xiaomi is, our view, is more like a consumer electronic manufacturer, or a brand owner, right? So we couldn't really understand. Having said that, this was done during the Trump administration, and it was put on the trade blacklist. I think what is interesting is during the Trump, so after Biden came into the White House, so Xiaomi was taken off the trade blacklist on the 12th of May. So I think that's a significant step, right? I think that makes a lot of sense, right? So it's not in the high-tech space. I don't think, I don't think Xiaomi worries, frankly speaking, the US tech community or the security community too much, right? So I think this is the first step, right? And I do think that that signals for some hopes of olive branch that is being extended, right? So and also the other thing I want to highlight to everyone is we don't think that the US-China tension will all of a sudden disappear just because Biden is now the US president, right? But we think that we have seen the worst of it, right? We have seen the worst of it, right? During the Trump administration, I think for investors like ourselves, we had to be very, very watchful of tweets that he may have tweeted in the middle of the night, and the market will have to respond based on that. And the worst part is a couple of hours later, these whole tweets were all retracted, right? So that this is very different from the current administration. I think for the current Biden administration, I think everything they have done makes a lot of sense, right? We do think that the competition pressures between these two great nations will continue. But having said that, right, for our portfolios, I think we have accepted it's going to be a fact of life. I think this US-China tension will persist over the course of the next decade or even further, right? So I think like I said, these two great nations are competing to see who can be the number one in terms of the arena of politics, in the arena of economy, and the arena of technology, right? So there will inevitably be tension. But from our portfolio perspective, right, we have already pivoted our portfolio so that we are able to take advantage of this US-China tension. Like, for example, we are buying stocks in China who are able to take advantage of what we call the China localization story, or the story whereby China will be self-sufficient in certain technology segments, right? So all these key stocks are all in China. And what is best is actually happening right now. And also, all these things are still relatively new because all these things happen because of the Trump administration, right? So a lot of these Chinese companies are still growing or are taking their first big step in terms of growing to be the next big Chinese tech giant. So from our point of view, the runway for us to invest into these stocks is actually quite long. So I think that makes these stocks very, very attractive, right? So once again, like I said, we have embraced and we have taken it that it's a fact of life that the US-China tension will continue on. And as a result, our portfolios are built so that we can take advantage of that. Okay, and moving on, we would like to introduce our RHB Big Cap China Fund. We are very, very humbled and obviously also very proud that this fund, the RHB Big Cap China Enterprise Fund, is one of the focus funds that is chosen by Fund Supermart. And a big shout out and a big thank you to the folks at Fund Supermart. And the other thing I just want to highlight to everyone is also some of our key features of our Big Cap China Enterprise Fund. For this fund, our key objective is we are trying to invest in quality, large cap China-related stocks. And more importantly, right, we are not constrained by where these Chinese stocks are located. So for those of you who may be familiar with A-share, for example, I think A-share, from our perspective, is just maybe 1/3 of my opportunity set, right? And for A-share in particular, right, it's a diversified pool of Chinese companies, but nevertheless, right, these Chinese companies are actually quite narrow. It's mainly in the consumer space or it's mainly in the industrial space, right? So because these are usually Chinese companies who get listed onshore. So as a result, their scale is obviously a bit smaller, and they are, like I said, in the consumer and the industrial space. But if you were to concentrate your investment in just the A-share, then I think you are missing quite a fair bit of the exciting opportunity set out there. Like for example, I think the crown jewel of China is in fact their Chinese internet companies, the likes of Alibaba, the likes of Baidu, the likes of Tencent. I think these are the crown jewels. These are the companies that can stand head to head against all the big US companies out there, the likes of Google, Amazon, Netflix, etc. Right? So these key Chinese companies are in fact listed not onshore on the A share, but they are listed in Hong Kong, and they are also listed on the US stock exchanges. So this is what we call the head shares. Head shares are Chinese stocks that are listed on the Hong Kong Stock Exchange, whereas US ADRs are obviously Chinese stocks that are listed on the US Stock Exchange, right? So for our portfolios, right, for our RSB Big Cap China Enterprise Fund, we are able to invest in all these three what I call buckets of alpha: the head shares, the US ADRs, and the A share. So I will want to buy companies that are the best Chinese companies with the best risk reward for our investors, no matter where they are invested. So this is what I think is a key feature of our Big Cap China Enterprise Fund. Okay. And the other thing is I'm also very happy to show everyone is our performance of our fund. So I've highlighted here. So last year was obviously a very difficult year for everyone. But if you look at the stock market, China's stock market was up roughly about 25%. So for our fund, we were up a massive 42%. So we outperformed the benchmark very nicely, roughly about 17%. But also more importantly, I think for investors, I think we should look at the consistency as well. For the last few years since I've been managing this fund, in 2018, the market wasn't that great. But even then, we outperformed the benchmark. 2019, the market was quite okay. And once again, we outperformed the benchmark, right? So the point I want to highlight to everyone is, no matter whether the market is up or down, over the course of the last 3 years, we have managed to outperform the market nicely. So over the course of the last 3 years, right, the stock market for China was up roughly about 30%, whereas for our portfolio, we are up roughly about 50%. So a very nice outperformance versus the benchmark, versus the Chinese equity market in general, which I think, right, shows that our process works. And last year was obviously a rough year for everyone. The fact that we managed to outperform the benchmark very nicely and outperform not just when the market was going down, but also outperform when the market was going up, shows the strength of our investment process, and also hopefully the strength of our investment personnel who's managing all these portfolios. And on this chart here, just a feel of all the top 10 holdings that we have for our funds, which we can talk about that a bit later. But I just want to highlight on a few key things. I think what is interesting from my perspective is to show everyone, maybe just give everyone a flavor, in the interest of time, a flavor of what the portfolio is investing in over the course of these few months, right? So more importantly, I just want to highlight that I think internet space or the tech space continues, like I said. I think these are the crown jewel of China. So as a result, right, we do have substantial investments into these few key sectors. Like for example, the online retail channel. I think the retail sales for China will continue to power on ahead. But more importantly, right, there are new sub-segments that are coming up as well. Like for example, the e-grocery. And obviously we know that the e-grocery has grown from strength to strength because of the whole COVID situation, because we are not allowed to go outside freely, right? So I think but the point is, once you I have experienced e-grocery, you understand how convenient it is. Maybe you will still go outside and buy your fresh fish, your fresh meat. But other than that, right, most of the grocery will be bought online, right? So I think in particular in China, whereby their logistics is very, very well developed, we think that going forward, I think the e-grocery channel will continue to go from strength to strength. So this is something that we are playing quite actively as well. And next, I'd like to talk a bit about the online entertainment segment. So our view is that I think the online entertainment segment is always evolving, right? Those of us obviously can remember Facebook, right? So all of us are still on Facebook. But having said that, there are new forms of entertainment or new forms of social media that is coming up every day, right? So I think China is actually at the forefront of it. So for those of you who are aware, who may not be aware, TikTok is actually from a Chinese company, and it all started from Douyin, which is obviously a product of the Chinese social media scene, right? So I think Chinese is leading the way in a lot of these new concepts out there, right? So in fact, if you on this chart here, I just want to highlight, just 5 years ago, right, there was no such thing like what we call the short form video segment. There was nothing of this sort. In 2019, it was roughly about 15% of the time was spent on this short form video. But if you look at 2025, right, that percentage will grow even more. I think what is also interesting is I'm sure there'll be new forms of entertainment, new form of social media that will sprout out over the course of time, right? So I think China is right at the forefront of it. So I think that's why I think that the Chinese internet sector is indeed very, very exciting, right? And on this chart here, I just want to highlight on a key sector that our Big Cap China Fund is investing in. That's in the new energy vehicle segment. I'm not sure but everyone is aware of this fact. I think everybody knows Tesla, right? It's obviously famous, right? The cars are very nice. Elon Musk is a master marketing person, right? So, but more importantly, I just want to highlight to everyone is this. Actually, right, China is in fact a leader in new energy vehicle. So in 2019, right, 56% of all new energy passenger vehicle were actually made in China, right? US only constitute roughly about 17% of total new energy vehicle or the new electric vehicle that are produced in the world. And obviously, Tesla is a market leader in that. 70% of all electric vehicle in US is from Tesla, right? So if you think about it, right, that's where Tesla is excelling in. But if you look at the entire world, right, you look at where China is. China actually constitute 56% of all NEV that's produced in the world in 2019. So I think that China is in fact a very, very interesting landscape for new electric vehicle, because end of the day, right, for the normal combustion engine vehicle, I think we all know already, the Hondas of the world, the Toyotas of the world, BMW, Mercedes, they have already dominated that segment. But if I were to ask everyone here, right, so what do you think will be the brand of your next electric vehicle? I think most people can only probably say Tesla. But in actual fact, there are a lot of brands out there, right? And China actually constitutes 56% of this new energy vehicle. So I think that's where the opportunity lies, right? So, but more importantly, I want to highlight to everyone is it's not just the brands that we're looking at. We are also looking at the supply chain. For example, the battery makers or the parts that goes into the batteries that goes into electric vehicle. So a lot of these names are actually Chinese in nature, right? So this is something that I just want to point out to everyone. And on this chart here, just want to highlight the other key strategy or the key sectors that we are looking at is actually in the green energy space, right? So what is interesting is I think green energy is probably one of the rare things whereby the whole world can agree upon. US, Europe, and China all now believe in global warming. They all believe that renewable energy is important. So I think that makes it a lot more interesting, for example, for the Chinese players, right? Because once the Chinese government put their mind to it, right, we know that it's going to happen. And a lot of these exciting new Chinese companies are in this space, right? So this is where we are spending a lot of our investment effort and time on in trying to find out who are the next winners in this renewable energy space. So this is something that I just want to highlight, and this constitutes a pretty sizable proportion of our portfolio. Okay, and just want to highlight to everyone, this is a summary of our investment thesis for this year. We think that this year, 2021, is a year of recovery and a year of growth. I think that thesis is still intact. Obviously, we have some road bumps along the way because of the Delta variant of the COVID-19, but I think you need to focus, or I think we need to focus on who are the countries, who are the regions out there who are able to weather this well. I think we have seen news about how efficient and how fast Chinese response is to any outbreak in China. I'm not sure whether you are aware, but just this week there was news that Nanjing Airport actually had a cluster of COVID. I'm not sure whether you are aware about that, but surrounding Nanjing, 1.5 million people were tested within one day. One day, China actually tested 1.5 million people in Nanjing itself to make sure that the thing doesn't spread. I mean, it boggles my mind, right? That they can harness that kind of resource and also with that kind of speed to actually able to clamp down and to control the whole COVID situation. So therefore, I want to highlight once again, right? I think it's important to differentiate the different countries and different regions in terms of how they are able to control the whole COVID situation. right? So this is something I just want to point out to everyone. And with that, my conclusion is, I think, once again, obviously, all of us are in some form of lockdown, and that's why we are doing this through Zoom. And it's important for us to understand that, I think, like I said, 2021 is still a year of growth and recovery, right? It's important to keep calm and stay positive, right? End of the day, it's very easy for all of us to despair and to be sad and in the current state that we are in. But for investment, right, it's important to understand that we need to look round the corner. And why I use the word round the corner is because oftentimes we are not able to see round the corner, but we have to predict that what we can see once we go past that difficult corner, right? And I think like Chinese says, 明天会更好, right? I think things will be better. I think as the whole world recovers, as vaccination rate goes up, I think the world will be in a better position at the end of the year versus what we are seeing now. So with that, I think China will be in a great position to take advantage of that. And that comes to the end of my prepared remarks, and I'll hand it over to the moderator.
Thank you, Mr. Tan. Mr. Tan, we have quite a number of questions, so I'll just go ahead and start asking the first one. Yep. Okay. What are the advantages of buying big cap stocks, as they're really quite expensive right now as compared to China's small cap stocks?
Okay. I have a bit of a differing view. I don't actually think that Chinese small cap stocks are in fact more expensive, are cheaper than the big cap stocks. Why do I say that? For example, a lot of these Chinese small cap stocks are actually listed on the A-share. Okay, and actually A-share in general, right, through history has always been a bit more expensive, or in fact quite expensive relative to stocks that are listed overseas. And why is the reason behind that? It's because if you are a normal Chinese living in China, there are two easy asset classes that you can invest in. One is property, the other one is stocks. So if you look at property sector in general, we all know that Chinese property sector or the Chinese property prices are in fact some of the most expensive prices in the world, right? Compared to the likes of London, it's more expensive than London, Singapore, Hong Kong, right? If you look at the property in Beijing, Shenzhen, and Shanghai, right? Why? It's because actually the money is all trapped there. It's not easy for a normal Chinese to take the money out. I'm not talking about all the billionaires, internet billionaires out there, but for normal Chinese people, right, it's very difficult to get their money out. So if they want to invest or they want to make the money grow, property is obviously a good segment, but because government is coming in and trying to clamp that now, and which means that they can only invest, or one of the key ways that they can invest their money is through the stock markets, right? And a lot of these small cap stocks are in fact in the Chinese stock market. And we all know that the Chinese stock market is maybe not as mature, as other parts of the world. So as a result, right, there's a lot of liquidity chasing a small number of stocks in China. So I think the small cap stocks in China are in fact quite expensive. But if you look at the large cap stocks in China, for example, the likes of Tencent, Alibaba, the Chinese banks, the insurance company, Ping An of the world, those guys are actually trading at very, very reasonable valuation. So you may look at the share price and say that, oh, the price have gone up. But don't forget that a lot of these Chinese companies have grown. Their profit base have grown massively over the course of the last few years. So if you look at a valuation perspective, right, a lot of these big cap Chinese stocks are in fact trading at very, very cheap, cheaper valuation than the small cap names. And the other more important thing is, for our big cap China Enterprise Fund, we focus on quality, right? We want to buy companies that allow us to sleep well at night, or allow our investors to sleep well at night. I'm very, very cognizant of the corporate governance issue and the auditing issues that some of the Chinese companies face, right? So the companies that I buy, I want it to be audited by the international auditors. I want them to follow the international accounting standards, because that gives me confidence in that the numbers that I see are reflective of their current financial situation. But if you look at the Chinese stock or the small cap companies, like I said, if they're listed on the Chinese stock exchanges, right, then they are being audited by the Chinese auditors, and they are also following the Chinese accounting standards, right? So I think that is a bit of quality gap from my perspective. So I do want to buy stocks that I think will grow, right, and will tend to prosper. And the other thing I want to highlight is also maybe it's also symptomatic of the whole Chinese system. I think the big will become bigger. Like for example, the likes of the internet giant chances are the top two or the top one will probably gain a massive market share versus everybody else. So the top guys or top two guys will have a massive advantage over everybody else. So we do want to concentrate our efforts on those top guys. But I'm not trying to say that we are neglecting the A-share or the smaller companies. So for our portfolios, we buy some of the more interesting Chinese companies, which I mentioned earlier, right? A lot of these tech companies, right, are starting to come up, right, because of the fact that a lot of Chinese companies are not allowed to use the US technology. So what can they do? They will never say, oh, I'm going to close down, I'm not going to participate anymore, right? They will try to find alternatives. And a lot of these alternatives are actually homegrown Chinese tech companies. And these, in fact, are not really that small. Okay, to be fair, right? The top two guys in for example, a certain technology segment may be Europeans or US. And since these guys are not allowed to be used by these Chinese guys, they have to go further down. And chances are the third or the fourth guys, right, are actually Chinese players. So that's where we are focusing our attention on. And even then, right, we are not talking about small names, right? Like I said, I do feel that corporate governance, the accounting statements need to be of certain quality, so that for me to be comfortable. Because at the end of the day, right, my portfolio, I only buy about 40 names anyway. So there are like thousands, there are like 5,000-6,000 names out there for me to buy. So I want to buy the best 40 for my clients. So I think in a lot of cases, right, this best 40 happens to be in the large cap space. Right. So I hope I answered that question.
Thank you, Mr. Tan. Okay, moving on. There's a question with regards to post-COVID-19. Yeah,
Okay.
Post-COVID-19, to what extent do you think that companies in Europe and US will rebalance their supply chains permanently and source closer to home? And how much impact do you think this will have on China's future GDP growth?
Okay, I think that's an excellent question. I do think that, okay, the short answer is obviously there will be some form of onshoring, right? So the last few decades or so, price was probably the key determinant of where you want to base your outsourcing center, right? Obviously, China excelled in that. So China became a factory of the world. But I think even before COVID, right, the fact that we have the US-China trade tensions, okay, there was already this kind of undercurrents at play even during that period of time already. So I think COVID actually built upon that kind of momentum. But so the short answer is that there will definitely be some form of impact. Okay, but my view is this, right? For those of us who are in the supply chain business, who are working in the industry, you know that it's not just one company on its own. All right, one company, like for example, even if you are like for example a Apple supplier or Apple assembler, you can't just plug your factory and just put it in the middle of nowhere, right? Because you do need other parts that goes into building a handphone. Like for example, a handphone, for example, you need parts from other segments. And not only that, right? It's not just the electrical part. It's also something as simple as the box or the plastics or the covering, right? So when you want to move, right, you have to move the whole village and the surrounding villages as well. Because it's not just one company, right? And if you look at it over the past 20 years or so, everybody has flocked towards China. Why? Because there's abundance of people, right? So just a classic case that I just want to highlight to everyone. For example, the assembler of handphone, Hon Hai or Foxconn. Not many people are aware. They roughly employ roughly about 1.5. They may not give you the full numbers, but roughly we estimate, right, 1.5 million people actually help Hon Hai or Foxconn assemble the handphones. Okay, 1.5 million people. Then the question I want to ask is, what do you think is the turnover of these factory workers, right? So imagine a factory manager for Hon Hai, or you have 1.5 million people out there assembling handphone on a daily basis. That is obviously a big challenge. But the bigger challenge is this. Of the 1.5 million people, right, 1 million people would not be there next year. They would have quit their job. So you have to find another 1 million people to fulfill the same role, right? You have to train them up from scratch to build handphones again, right? And the best part is you get to do this year after year because 1 million people will move away. So how many countries out there can you actually think about that can replace 1 million people year after year after year. There are not many countries out there. India, Africa, Indonesia, maybe, right? If not, then it's China. So there are very few options out there. You know, you are talking about things like, for example, handphone. I'm just using handphone as an example. But just to showcase, right, it's not so easy to onshore. But obviously, you can onshore things which are highly capital intensive, right? Obviously, you want to, you know, build a semiconductor factory or whatever, you can, because all you need is money, right? You need money and you can do it. But for most stuff out there, right, that requires people, that requires a village, right, a village of suppliers, it's not so easy to move. But having said that, right, it's also important to highlight that this is something that we understand. That, for example, pre-COVID, if you have $100, probably $99 will go towards building a factory in China. But now, with $100, maybe you spend $80 building a factory in China and spend the $20 elsewhere. Indonesia, Malaysia, Africa, India, whatever, right? You need to diversify. So that's inevitable, right? But having said that, right, our view is China is also not standing still. They are also trying to climb up the value chain. And if you look at the policies that Xi Jinping have, right, they are talking about dual circulation policy. They also know that the world is doing that to them. So what is their response? It's the other circulation, dual circulation, which means the other part, which is self-sufficiency. They have to depend on themselves as well. So I think the whole world is also evolving, right? The whole world is moving. And China is also responding to mega trends that's happening in the world. But I guess the point I want to highlight to everyone is, yes, there is going to be some form of onshoring or reshoring, but the second point is it's not so easy, because end of the day, we need a whole village and we need literally an army of people to help assemble handphones and the likes. Okay.
Okay, cool. Okay, Mr. Tan, let's take questions with regards to the RHB Big Cap China Enterprise Fund. Okay, we have an audience asking why this fund has 64% in Hong Kong while only 14% in China. Why not a larger allocation in China?
Okay, okay, the short answer is, right, give me a second. Okay, the thing is, right, even our Hong Kong, they're actually not Hong Kong stocks. Okay, the stocks that I buy in Hong Kong are essentially stocks that are listed in Hong Kong, but they're not Hong Kong stocks, right? I'm sure all of us are well aware of the political issues that Hong Kong have, right? So we do not actually have any stocks that are linked to the Hong Kong economy, right? The stocks that have the 60+% are essentially stocks, right? That are essentially Chinese stocks that are listed on the Hong Kong exchange, right? So their P&L, their revenue, their profitability have very, very little to do what is happening to Hong Kong, but more to do with what is happening to China. But it's the way that how we classify it. If I listed in Hong Kong, then we put it under Hong Kong. But in general, because it's a big cap China fund, all my stocks are related to the prosperity and the growth of China.
Okay, all right. Another question with regards to the performance of RHB Big Cap China Enterprise Fund. So this audience is having a negative growth in terms of its performance returns. So the fund, according to the audience, is not really performing. So what is your future plan for this fund? Yeah.
Okay, I think that's an interesting question. I must apologize if you're not making money from the Big Cap China Fund. But if you look at this chart here, right, we should concentrate on the blue line, right? So if you have invested any time over the last 5 years or so, you would have made a pretty decent return. I only think that I think that could have happened because I think you might have invested during the January or February period of this year. That was before there was de-rating in the markets from the fact that the 10-year bond yield started to tick up. So I think the Chinese market even on a year-to-date basis is up roughly about 4+%. So there might be certain points in time when if you have invested, you might be slightly losing money. But if you look at this chart here, we are almost going to break the last high already. So which means most of my investors, if not all my investors, would probably be in the money, right? So if you look at this chart here, right? So yeah, I think that's probably a question, because if I look at this chart, we are breaking new highs. We are quite near to our old highs. That's the way I could probably phrase it. So I hope I answered that question.
Okay, there's a sector questions with regards to Chinese insurance stocks.
Okay.
They are trading at attractive levels. So do you see opportunities in this insurance sector, both for the A shares and also the H shares?
Okay. I think the Chinese internet sector in general, right, is certainly very attractive. Obviously, we can talk a bit about the under-penetration of the Chinese insurance market, right? Obviously, insurance is a pretty new concept. In China, new as in not everybody in China would have insurance. So I think the penetration rate compared to Singapore or Malaysia is very, very low, right? So there is huge potential there. So that's one. And the other thing is also want to highlight is that obviously China Chinese used to be a centrally planned economy. The government used to take care of everything in terms of healthcare and everything. But because of COVID, because of what has happened in the last few years, I think people are more aware that they want quality healthcare, especially in times of trouble, right? So, and they're willing to pay. And obviously, more and more people in China are getting richer and richer. So they want to pay and they are willing to pay, right? So I think that is this whole segment that is obviously growing, right? So the pie is growing and the percentage of people who want to buy insurance is also growing. So definitely, overall picture-wise, very attractive. But the other thing is stock selection is very important. Okay, why is it so? Okay, 10 years ago, I was actually an insurance analyst. So when China Life, Ping An came to the market, I was there. I was at the IPO show. I spent 1 week in China doing nothing but just interviewing insurance company after insurance company. I spent 1 week in China about 15 years ago. I traveled all over China to look at different insurance company. And a big lesson that I take with me even until now is there is huge disparity, right? The likes of, let's say, for example, Ping An is very, very commercial. People are of international pedigree. Their people are from all over the world. Like, for example, not many people are aware. The CFO, I know 2 CFO of Ping An. They're all Singaporeans. But can you imagine Singaporeans? Our Chinese is not that great, right? But they are the CFO of Ping An, right? So the CEO of Ping An used to be a Hong Konger, right? So there are like Ping An, for example, they do accept and embrace people of various nationality. Okay, but if I were to look at other insurance companies, which I will not name, other insurance companies, for example, out there in China, a lot of them are SOE. They are state-owned enterprise, right? So I've met more than my fair share of these state-owned enterprise people, right? A lot of their chairmen or their CEOs are actually government servants, right? And what is worse is that they tend to do merry-go-round, which means I am the insurance company, I'm the chairman of insurance company B, you are chairman of insurance company C. If I beat you too much or I win you too much, then they will switch our roles, right? Then I will become the chairman of your company and you become the chairman of my company, right? So what that creates is, I don't think it creates a very healthy environment for competition, right? Because, and furthermore, a lot of these chairmen and whatnot are actually of vice minister rank, right? So if you're chairman of China Life, for example, right, you are almost like a vice minister in China. That is your rank, right? So if you are a vice minister of China, I think your thinking of how you want to proceed with your next step of your career is very different from someone from a more commercially minded insurance company, right? So I think stock picking is very important, right? And if you notice, right, a lot of these Chinese insurance company, their chairman and their management boards and their management have changed a few rounds over the course of the last 5 years or so because of the phenomenon, what I just said, because they keep rotating chairmen and CEOs, right? So that doesn't really inculcate in them the mindset of long-term business, long-term planning and stuff. Whereas the likes of, for example, AIA, for example, who are obviously in China very successful, the likes of Ping An, right? It's very commercially run, right? So to my point, I want to highlight to everybody is, I think there is big differences in the insurance companies in China, right? Because the profit motives may be different, right? Management structure may be different, right? So you have to be careful. But overall, in industry in general, I think it's very attractive. Okay, I hope I answered that question.
Okay. Do you have anything to share with regards to Chinese education companies?
Okay, so
listed in Hong Kong. Yeah, because they're falling up to 50%.
Yeah. I'm sure that this is because of the news that happened today, right? So we're happy to say that we have zero exposure to the Chinese education company. I think this was, I think we sort of expected that it was coming. It was telegraphed, but the strict, the how strict this regulation were even caught me by surprise. So all I can say is I am happy that we don't have any exposure there, right? We gotten out of the Chinese education company probably in the third quarter of last year. It had a pretty nice run up because obviously during the whole COVID period, you cannot go to school. Then online was great, and you obviously study at home lah. So that did well. But it went to some ridiculous levels that we thought that it's time for us to get out. So we haven't been playing this stock for the last 1 year or so, right? So, and in fact, when the share price started coming down, we were actually quite tempted. So we went in and we actually studied the whole sector again just to make sure that whether we miss anything. But our decision then at the point in time, that was just a couple of weeks ago, was that we give it a miss because we felt that the regulatory pressure was too much. I cannot quantify what was the addressable market. I don't know how strict the government was going to, how hard the government was going to come down on this internet, this education company. But the recent news that we got, or rumors right, at this point in time, we have yet to see whether it's real or not. But I think it's probably going to be quite true But yet to see the real paper But I think those are very strict measures and these guys would have to pivot, right? If not, a large part of their business would essentially disappear over time. But like I said, I think the data or the news is not confirmed yet. But I think the initial indication doesn't seem that great. So that's why for us, we are happy to be out of the sector and we don't have any investment in that particular segment.
Okay, so another question, are you planning to reduce your exposure to ADR since you expect most US listed companies to move back to China?
Okay. Once again, I think that's a great question, but I just want to clarify the whole ADR issue. Okay, when we invest, we don't actually differentiate between, I want to invest how many percent in ADR, I want to percent how many percent in A share or H share. Okay, we look at stocks from bottom up perspective. We buy a stock because we like it. Okay, so this is something I just want to highlight. So I don't specifically allocate ADR versus H share versus A share. That's not how for us at RHB, we tend to do a deep dive and we like to buy stocks from bottom up perspective. So that's one. Second of all, right, in a lot of cases when we buy all these ADRs, right, one of the key criteria that we had since last year was that because of Trump, right, we wanted to buy stocks who actually have a pretty easy, I'll use the word escape route out of the US stock market if they wanted to, right? So that was our strategy when Trump was the president, because we know how fierce, how aggressive Trump can be. So even though I like this company, I just wanted to make sure that if they wanted to do a secondary listing, they can do the secondary listing on Hong Kong, on the Hong Kong exchanges or on the mainland exchanges. So that was one of the key criteria. And then that actually worked very well for us, right? Because once all these stocks, right, were listed on the Hong Kong stock exchanges, they actually blossomed. Okay. So the other thing I want to highlight to everyone is actually in a lot of cases, right, the stocks that I own, right, for example, the likes of Alibaba and whatnot, is listed on both exchanges. It's actually, I'm indifferent to both, because, right, the share price actually quite linked close together. So actually, I own most of my shares because I have Alibaba for quite a while already, right? Most of my stocks were actually US ADR. So when the Hong Kong Alibaba came into play, right, all I needed to pay was like tens of dollars, right? And I got the US ADR and converted back into the Hong Kong ADR. I didn't really have to do much, right? So from our perspective, right, a lot of these stocks are fungible. So we use the word fungible, means it's the same. It's almost the same. It's almost, obviously one is listed in US, one is in Hong Kong. But when you translate back the prices and everything, right, it's more or less the same. It may off by a few 1% or whatever, right? If not, the arbitrage guys will come in and take it away. So in general, right, we don't differentiate between the two, right? So that's one. For those guys who have listings, dual listing both in Hong Kong and in US. So this point I want to highlight. So we don't really discriminate, right? But for me, right, as time goes by, because obviously I'm in Asia time zone, it makes more sense for me to buy the Asian version of the same stocks, right? So this is something I don't highlight. But like I said, the share prices and valuation are almost the same, almost practically the same, right? And the other thing I just want to highlight to everyone is also, maybe another part of the question is also, yes, a lot of these US ADRs are coming back, right? They have a secondary listing or even primary listing. So for those of you who are unaware, it's a bit technical, but some of these US ADRs, right, for you to have what you call secondary listing, you need to have 3-year track record in the primary market before you can get the secondary listing. But what is interesting, in fact, just 2 weeks ago, XPeng, right, who actually had a pretty short listing history in US, was actually granted a primary listing in Hong Kong. So you can see that the Hong Kong exchanges are making efforts to make it easy or very easy or very simple for a lot of these US ADRs to come back, right? So I think the US ADR issue, my view, will slowly resolve itself. Because end of the day, right, some people or maybe Trump or whatever may think that, oh, you know what, without the US stock exchange, the Chinese ADRs will starve of capital or whatever. But that's not how, from my investment point of view, I don't think that's how the world works. Because money flows, right? US dollar, whether I use it in Hong Kong, whether I use it in America, is still the same, right? So these guys can still raise money on the Hong Kong Stock Exchange, or in fact on the mainland stock exchange. And I will also argue, right, for a lot of these Chinese internet companies, right, if you go onto the Hong Kong or the Chinese stock exchange, you will get higher valuations. Why? Because like I said, right, in A share, right, the money is all stuck, right? So that's why valuation is more expensive on the A share. So if these Chinese guys can buy a Chinese internet company that they use on an everyday basis, like Meituan or Alibaba or Tencent, they will buy, and they know the company better than Ang Mo who is living in Boston, right? So it's a very different dynamics altogether. So I think the valuation will in fact be better. So in fact, this is one of our strategies that have done well for us also, right? So I hope I answer that question, because it's not an easy question to answer, because there's so many different aspects to this whole US ADR issue, right? So but in general, I just want to highlight, right, I don't think there's an issue at all. I think history will judge this and say that I think US made a mistake. The net beneficiary is going to be China and Hong Kong. The net loser will be the US because of this move. Okay, hope I answered that question.
Okay, thank you, Mr. Tan. Mr. Tan, we'll take one final question.
Sure, no problem.
Okay, maybe we go to a question that relates to RSV Big Cap China. Just a very simple one. This audience is asking, how long and how short for this one do you hold stocks? Okay. For example, say in a year.
Okay, we typically are long-term investors, right? So maybe just give you an understanding of how we do a bit of our research, okay? So my team is actually very experienced. I have been doing this for 20 plus years. The average level of experience in my team average is about 14 to 15 years. So when I hire my senior guys, right, they need to have at least more than 10 years of experience. Okay, why do I use the word 10 years? It's because if you are in the market for less than 10 years, right, you have only seen prior to COVID, you have only seen one market, which is one bull market all the way from GFC, 10 years, right? So if you have less than 10 years experience prior to GFC, right, you've only seen one market, right? So I need people who have seen both the bear and the bull, right? So when I hire my senior guys, right, we tend to hire people who have 13 years of experience. So they have seen the GFC. They know what is it like when COVID happens. For those of you who are a bit younger, that fear when every day the whole market was dropping and then a circuit breaker happening. That one, fortunately, unfortunately, I've experienced it before, right? So I don't panic. So the whole team was actually very comfortable. We were actually buying stocks. When people were selling, we were buying. So the point I want to highlight to that story is because we invest for the long term. We actually went back into the market, right? We actually very defensive. We went for our portfolio. What we did very well was because on the 20th of January, we actually went defensive on the market last year, right? And 22nd of January was actually when Wuhan went into lockdown. So we went defensive. We sold all our travel stocks, all our consumer stocks 2 days before Wuhan went into lockdown. Then some people say, oh, obviously, it's very obvious, right? One lockdown, you have to sell one. But the truth of the matter is, we were wrong for about 6 weeks, The market from 22nd of January went all the way down to February, 1st of February, it went down. Then for 1st of February, all the way until Valentine's Day, right? The market actually went up, By the time it's Valentine's Day, right? The index was higher than the day when I sold. So I was also scared. Did I read it correctly? Because I felt that one lockdown is a big problem. How come nobody is worried? That was my feeling. But I took the opportunity and I sold more and more stocks. I went more and more defensive, and I was wrong all the way until February. So on hindsight, people say that it's very obvious. What I tell you, if you in my shoes, at Wuhan lockdown and share price went up, you will also be scared, right? But obviously, after 14th of February, the market collapsed, right? Obviously, we were sitting pretty. Chinese New Year was great for us. 2 Chinese New Year ago, market was collapsing and it was great because we were picking up stocks, right? And when we went back into the market, right, that was in April. In April, we went back in. It's not because I knew that the market was going to turn. It was because at that point in time, right, a lot of stocks were very cheap. And that's to answer that the question again. I didn't know the market was going to turn. All I knew was the stocks that I love, right? I wanted to buy at GFC low. I had 2 standard deviations below mean. It was so cheap. I never seen this kind of pricing before, and yet everybody was selling. So we were out there buying. Some of the stocks I bought, one of the stocks I bought when it was down 30-40% on a single day, right? So we were buying at 4 p.m. when nobody was. We were the only guys taking all the beats, right? But that is to highlight, right? We invest for the long term. We buy stocks, and why we can go in is because over the long term we felt that the share price was super duper cheap already. People were overselling. They were too negative. They were literally throwing out the baby with the bath water. Right. So in short, right, to answer your questions, our guys, right, all my guys, right, were from the sell side, meaning that we build models. I was from the sell side. I was with Merrill Lynch as my first job. I build models. I talk to senior management. I don't need the sell side essentially to help me. I can do my own. That's how I hire my people, because we want them to understand the stock well. We want them to be able to build model from annual report. Right? When COVID hits, nobody to talk to, whatever, it's okay. With computer, internet, I can work, right? So I think that shows, you see. So because of that, I have to take a long-term view on stocks and trends and on sectors. I cannot trade, right? So this is something I hope I answered that question.
Thank you, Mr. Tan. Thank you for your presentation and also your replies. Very insightful regards to China. So I would like to thank Mr. Tan and also RHB Asset Management for making this event possible. So ladies and gentlemen, unfortunately, we have to end this session this evening. So if you have any further questions, feel free to drop an email to our investhelp.my at fundsupermart.com. Okay, ladies and gentlemen, we'll end it here today. Next Tuesday, we have another session. Also, we are also continuing our recommended fund webinar series. We have Affin Hwang Asset Management. Same time, 8 p.m. next Tuesday. We see you next week. Stay safe, everyone, and good night.
Thank you, everyone. Stay safe. Take care.